Awesome. Thank you. Hey, Ryan, how's it going?
Hey, Preeti. How are you? Thanks for having me.
Awesome. Super excited. I know we've known each other for quite a while now, and excited to have you on finally. And you picked an interesting topic to talk about, which is talking about what tokens you think will underperform or overperform the market. And I think you've been prolific about sharing sort of these hypotheses every year of what you think the market will do. And I'm assuming this is one of your hypotheses, so I'm excited to dive into it today. And the claim that we're going to debate is Ryan thinks that tokens with large token treasuries, founder rewards, and high inflation will significantly underperform the broader crypto market. And to be honest, it's somewhat of a niche topic. So before we even jump into the claim, I want to get some definitions out of the way so that people are on the same page. So just to start off, let's talk about what it even means to have something called a token treasury. Let's start off with token treasuries. Like, what does it mean for a project to have token treasuries?
Sure. So obviously, Bitcoin is the original crypto asset, and back in 2009, there was no such thing as an ICO. Bitcoin was fairly launched; you could mine it from your computer. Early forks had the same dynamic in that they were algorithmically generated according to a certain set of rules. You didn't have to, as the founder or creator of these assets, reserve yourself or your team any number of tokens for ongoing developments and funding the initiative because it was all open source and freely accessible. More recently, notably in 2017 with the ICO boom, it became the standard for teams to raise money for themselves and then also reserve a certain percentage of the tokens that were created for ongoing distribution at the discretion of either the company, an associated foundation, or the early employees and recruits that would either vest over time or at least could be sold over time as the value of the network increased. Ethereum was the first one at scale to really do this, and it worked. But part of that was, I think, due to the novelty of their sale at the time, it was unclear whether any other crypto assets would actually succeed. Ethereum's crowd sale was democratic on the one hand, but it also gave many early backers and folks affiliated with the Ethereum Foundation large chunks of the pre-mine, if you will, of Ethereum tokens. So that has kind of become more of the norm versus the exception. And you know, some of the excesses of 2017, the incentives were wildly misaligned between how much was controlled by a project versus how much could be earned by the community or how much was generally available for sale through a public token sale that wasn't just constrained to the insiders. But I think what we've seen in 2017, 2018, particularly with the SAF, the Simple Agreement for Future Tokens, is now you have a large overhang, not just of kind of early users, but of professional investors that must sell their tokens when they can because they have a fiduciary obligation to their limited partners, but also a much larger percentage on average of discretionary token reserves that can be sold for future financings from these projects. So the thinking being, rather than raising all the money for this protocol in a one-shot deal and then needing that to kind of cover your development costs for all time, now these teams have a little bit more discretion if they hit milestones to sell down their positions. So it's definitely something that I think is going to depress returns because it's simple supply and demand, right? You've got a massive market of sellers in some of these assets that some will argue that sell side pressure is priced in, but I would argue it's not even close to being considered in terms of how much weight that will have on some of these assets.
So before we get into how they'll perform, so the incentive for creating these token treasuries and founder rewards and inflation, why are projects doing this? Why aren't they just keeping their protocol super simple?
Well, it is relatively simple in terms of value alignment and making sure that the economic incentives work for those that are actually going to do the work to bring some of these protocols to market,
Yeah.
and those that are going to do the work to secure these networks. I think what's different with newer tokens is you can't just start with a fair launch like Bitcoin, right? What happened with Bitcoin, what happened with Ethereum was a miracle, and it's something that won't be repeated if for no other reason than people saw what the returns were like if you were an early user and investor in Bitcoin or Ethereum. It's historical outperformance in terms of returns. So now all of these interesting developer teams that might be working on something new and novel that does have an associated crypto asset, that becomes a much more crowded trade at the very beginning, at the inception. So the equivalent of like the seed round can be wildly overinflated. And if that's the case, you can't expect a fair launch where the early developers and tinkerers that are building that protocol will be able to acquire enough for this to be interesting for them to continue to put their effort into. So this would be the equivalent in fundraising of making sure that there was an option pool reserved, right? You wouldn't raise money from a venture capitalist and then just pay your employees in cash. Those VCs are going to see value or incentive alignment across the early employees and kind of keep people working on the project.
That's a good analogy of traditional companies and option pools to token projects and these sort of founder rewards and so forth. So with that out of the way, and then one other definition I want to kind of talk about is, like you said, high inflation. Like, how high of an inflation are you referring to?
Well, it's all relative, right? If you want to just keep things super simple, you could look just at the top 10 assets by market cap. And you'd see that the inflation rate for XRP and Stellar Lumens is somewhere between 25 to 40% annualized if you factor in their secondary sales from their treasury. In fact, just earlier today, Ripple Labs investment arm, Xspring, announced that they were going to allocate 1% of their fully diluted supply of XRP and that treasury to a project called Coil that they could then distribute to their users. So if Coil were to unwind that position, overnight, which they won't, but if they were, that would be, not just 1% inflation because 1% of the money supply is in the market, but 1% over what is currently outstanding, which is probably closer to 22 billion XRP.
Got it.
And so XRP and Stellar are probably the two highest profile versions of assets that have made that decision to unwind these treasuries over time. But you've also seen other teams either throw tokens into escrow or even burn some of the tokens that they have at their disposal just to make sure that overhang it doesn't scare away users or investors in the protocol.
Got it. Okay. So now that we kind of got those definitions out of the way, in your argument on True Story, you wrote that the reason you believe that these won't matter or these will underperform is because of basic supply and demand is all that matters. Can you explain what you mean by that?
Sure. I think the only thing that really mattered in 2017 on the way up was unbridled enthusiasm for all things crypto, right? Everybody was making money. It was a massive bubble, and demand outweighed supply. And many of these assets that were artificially constrained in terms of the circulating supply that they had via ICOs were bid up to nosebleed levels. They've since come back, 99%. And one of the things that helps those assets come back down to earth, if you will, is the fact that there's persistent sell side pressure, right? So typically in these bubbles we've seen in crypto the last few cycles, the rally on the way up can rip your face off, right? It's just it happens all at once. I think in Q4 of 2018, even Bitcoin, which is the blue chip, the most mature asset, went from a few thousand up to 20,000, right? So and then many of the other assets went many multiples higher. That really just stemmed from the fact that there was a wild imbalance in supply and demand. Many people, especially for the more thinly traded assets, were trying to buy potentially thousands or tens of thousands or hundreds of thousands of dollars worth of these tokens when there might just not have been that much available. in terms of the outstanding supply. What you see on the way down, though, particularly with assets that have large treasuries that are getting unwound or high rates of programmatic inflation, is this just bleeding of value, because every single day you need $10 of buy-side pressure to offset $11 of sell-side pressure, and so you've got this kind of long-term imbalance where you just know that either because miners need to cover their bills, or there's a scheduled secondary sales policy on the part of the team. This is just going to be daily, sometimes 24/7 persistent bleed on the order book for many of these assets.
Interesting. So you're saying, like, even though people might think that these additional tokens that are going to be additional supply of tokens that are coming into the market via founder rewards or inflation, even though the market may think they're priced in, you're saying they're not priced in.
Yeah, I think that they're not, because I think everybody has a very short-term mindset in this market. And so what we've said, from the point that we started Messari, this is one of the most important things that we focused on. In a sentiment-driven market, understanding the rate of supply issuance is probably one of the closest things you're going to get to a fundamental metric that you should track for these projects. If you know, just no different from an IPO, if you knew that post-IPO, Uber was going to continue to sell stock at a rate of 40% annualized. Post-IPO, right, that's going to be 40% dilution that you need to offset with an increase in the price per share, just to kind of run in place of the current market capitalization. And that's essentially what's happened with many of these assets. Zcash is another good example, right? The market cap has been much more stable. The price chart is horrific, right? Because for the first year, Zcash's inflation was essentially infinity. And that mattered because the starting price was so high versus when Bitcoin started, and it was basically nothing. It was just a novelty. In year two, the inflation was 100%, right? So whatever the market cap at the end of year one was for Zcash, you had to assume that they'd have to raise essentially the equivalent of $1 billion ICO just in that next year, just to run it in place at the same price, and have the market cap double, and so on and so forth. So I think on the one hand, you've got the more centralized treasuries like Ripple and Stellar, but on the other, what's interesting is many of these fair launches or programmatic assets, their inflation is still very high, but will be coming down over time.
So there was a counter argument that came through to your point on it being priced in, and one of the community members gave Litecoin as an example. And Litecoin, people thought it would be priced in, people didn't think it would be priced in, but it was. So is Litecoin just a counterexample to the market being mature?
Am I on mute?
No, you're good.
Okay. I think that Litecoin example is interesting. I think people generally bought the narrative that the halving was going to further constrain supply for Litecoin. But in reality, the annual inflation rate for Litecoin is only a few percent. Right? It's negligible. I think you can generally you can live with low inflation, right? The dollar even is able to maintain its value at a couple percent inflation per year. And that's kind of the approach or the point that we're getting to with Bitcoin, with Litecoin, with Ether, with some of the more mature crypto assets. Even still, you saw people kind of buy that narrative for Litecoin. I think it was just that, right? People bidding up a narrative that has a very small sample size. And in fact, once the halving event happened, you saw Litecoin come back down to earth, right? It corrected. So I think these short-term swings in market value are not necessarily the greatest signal that you want to look for if you're considering whether any of these assets are worthy of investment. But if you are taking a very long-term time horizon, the best time to buy some of these assets might be to just wait until the inflation is under control, or at least you have some clarity on how these assets will be unwound over time so that you're not just buying into a massive sell wall.
That's fascinating. So I kind of want to get a little bit deeper into like specific projects because like I think it'd be good to talk about in that context. So like what are projects that have these kind of inflationary rewards or founder rewards that you're talking about? The ones that come to mind are Ethereum, Zcash, Tezos, any other?
Inflationary founders awards, do you say,
Sorry,
or
inflation or founder rewards?
inflation or founders awards? Well, I don't necessarily think that it's a bad thing to have a little bit of both, right? It comes down to how predictable is that ongoing sell side pressure, right? So if going back to the public company example, if you have an executive like Jeff Bezos or Tim Cook that's going to be selling shares, normally they do structured selling agreements where they're selling X number of shares every week, every couple of weeks in the open market. But it doesn't change from period to period, right?
Yeah.
And I think some of the teams in crypto have been pretty smart about metering the rate of their sales, either at the founder level or the foundation level, and saying we are subject to a 4 or 6 year vesting schedule. We can only sell X amount per year. When we do sell, we disclose it to our communities. And that's really what we've worked on with a number of projects via our disclosures initiative at Messari already, with the 50 or so assets that are currently listed on our site.
Got it. And so, digging into that, like Zcash and Ethereum and such, I think they're reaching their maturity in terms of the inflation, right? Or are they going to, would you say that, or do you think they're still high risk? You keep getting muted. You're mute.
Ethereum, I don't know the inflation off the top of my head, but it's somewhere in the 3 to 5% range. And on an ongoing basis, they might have 5% inflation once they make the migration to ETH 2.0. But again, if you expect that many people are going to be automatically staking to ensure the security of the network, then essentially they're paying themselves, right? So that 5% inflation rate is just coming back to any participants in the network in the form of almost a stock dividend. With Zcash, it's more interesting because this could be one of the halving events that is actually very high signal, not necessarily because it was unpredictable, but because the inflation rate in the next 15 months is going to drop from 37% down to 13%.
Yeah.
It's a massive improvement, right? In nominal terms, in terms of daily issuance. I think people get too hung up on thinking about the kind of headline rate, but if you just think about the nominal issuance, you're talking about hundreds of millions of dollars in less sell side pressure on an annualized basis for Zcash in particular. And that becomes very powerful if you think about it in the context of where some of these other top projects have raised money, even in private markets from venture investors that have plowed, in many cases, 9 figures into top 25 assets.
So then, like, if a project is launching a token now, would you say they should just simple supply versus having like these things like founder rewards or token treasuries?
Well, you'd have to define simple, right? There's a difference between doing something that's clean and common sense and fair, and something that's highly inflationary, right? So if you look at Grin for an example, Grin is insane in terms of the inflation rate that you'd expect from the project in the near and medium term. But it's predictable, right? It didn't have a founding team. It didn't have a pre-mine. It had a bunch of miners that were competing from day one to secure the network and earn some of the network rewards, but it's still a very highly inflationary network. So I think the halving reward schedule that was baked into Bitcoin might have been an accident in many cases, just because it was kind of like the first iteration, but it's clearly worked. And so I think to the extent that you want to think about how to incentivize early participants, you would want to look at something that maybe is on some type of sliding scale or having schedule. But when you're thinking about incentivizing the teams long term, you probably want to think about that more in the range of how a venture capital investor would think about incentivizing employees through an option pool. So that's probably not 50%, it's probably not 1%, but it's somewhere in between. And I think that's where a lot of the interesting experiments are getting done right now.
Fair enough. And then let me, um, so like one of the interesting things about the 2017 bull market though is that like 5 of the 10 assets by ROI had double-digit inflation. And so, what do you say to that? Do you think that like that's just another outlier case, or how do you corroborate that with your thesis on
Well, some of the top performing assets in 2017, they had such insane rallies because they were starting from such a small base, right? So I'm not going to argue that 2017 was a crazy period. I'm thinking about just today as kind of a snapshot in time. And one of the reasons that I don't think you're going to be able to replicate 2017 returns with those types of assets is because much like the public markets in kind of the equities realm, it's not possible to get in early, so to speak, in a hot ICO, right? To the extent that you are able to invest early, it becomes a very lofty valuation for basically a seed stage investment. But if it's a professionally managed project, more often than not, the teams are scared away from doing an ICO or IEO, particularly if they're domiciled in the US or Europe. And instead, most of the value could accrue to the venture investors or the funds that are actively investing pre-sale. Those funds are going to have to sell. The question is whether there's going to be any retail demand on the other side. And I think that'll look a lot more like public technology IPOs, where you've seen Uber, Lyft, Slack, all decline from their initial public price, and basically all of the value of those companies was accrued to the venture investors versus the retail investors. So I think the dynamics have totally changed based on the emergence of the crypto fund ecosystem as well.
Interesting. That's super fascinating. There was a few audience questions that I want to start getting into, and this one says, like inflation, for example, for a project like Ethereum will go to zero. So when you say high inflation, is that any rate of high inflation? And like the question is like, what if the inflation decreases over time because like something like Ethereum will eventually reach zero?
Yeah, I mean, I think I'd compare it to other stores of value, right? If you if you're growing the monetary base by 25% a year, well, then your demand has to increase 25% a year.
Yeah.
So it's a lot easier to store value in assets that are going to inflate between 0 and 5%, or even deflate in the case of some of these tokens that have burn mechanisms. But I think you start getting north of 10%, certainly 20% or more. It becomes much more difficult to make that ground up, because you're just again, I mean, you're buying into you're basically buying someone else's bags, right? Whether it's the Ripple founders or the XRP affiliate, talking about the Stellar Foundation. Or in Zcash's case, you're basically buying directly from the miners that are trying to cover their costs because they're just liquidating this on the spot, and it's a lot of money and new issuance that's hitting the market every day. It's tough to overcome that.
Fair enough. So you're basically saying like the inflation should be realistic enough to meet the demand of the project.
And by the way, it's not necessarily a bad thing to have this type of inflation early on in a project. I'd say it's part of the price discovery project. So I wouldn't say that Zcash or Grin are poorly managed projects, right? Or have misaligned incentives necessarily.
Yeah.
But they're just like very early stage. So you can't have it both ways, right? If you want early access to these assets, and you want anybody to be able to use them, then you have to kind of sign up for the early volatility. It would be no different than if you were able to trade stocks of a startup, right, in real time, right? What would the volatility of the price of shares of True Story or Messari be if it was on a day-to-day basis? It'd be that's no way to live as a founder. I think we can agree on that. It'd be too much of a distraction. It'd be just nightmarish to deal with. But that's what many projects you're signing up for. And the only alternative is to kind of stay private and then ultimately kind of come to market when you've got a predictable low inflation rate. Even then, the investors that are going to be buying in are normally going to be buying from an existing investor that is going to have to sell at some point.
Yeah, no, this is it's a very nuanced point that you bring up about, like, this is the first time in history, like, where companies and founders have to think about, like, they're basically IPOing at a seed stage, right? And so, like, they have a token, their project is immature, the supply is going up, they have no predictable demand for this token, the market's immature. So then, like, it makes sense why you think that, like, something with high inflation, it comes down to just like simple supply and demand in that case. So trying to understand your argument a little bit better. So there's another question from the audience, and this person is asking, like, what do you think about Tezo's inflation protocol upgrades?
I haven't followed it as closely. So what is the TLDR on their proposed inflation upgrades?
I don't know that, but maybe he can answer and I'll come back to that question. But there's another question that says, it's not for, sorry, let me mute you, you're echoing. If it's not for, okay, if it's not for inflation, what are better ways of aligning incentives for crypto teams outside of token ownership?
I think that's the $1 billion question, right? It still remains to be seen and is debatable whether many of the assets that we see today are going to hold any value. Another topic that I've spoken about and written about and still believe is true is that today you've got some bona fide cryptocurrencies that are vying to be digital gold or digital oil and basically be a reserve currency for valuable applications and assets that are built on their protocol. For Bitcoin, it's the decentralized currency of a distributed central bank. For Ethereum, it's become the decentralized currency for basically a distributed investment bank. If you think about asset issuance, and DeFi is probably the killer app for Ethereum. And then, obviously there are going to be much smaller cryptocurrencies that, there's a power law distribution in terms of who actually wants to hold them or who thinks about them as a store of value. But most of the assets that were issued in 2017, 2018 were more in the quote unquote utility token realm. And I don't really see much value in most of the assets that are trading outside of whether there are valuable fees that might be possible for contributors to the network to earn. So what I mean by that is inflation funding can only get you so far.
Yep.
Because at the end of the day, you realize that you're basically just moving money from one pocket to the other. If everybody at scale knows that in order to earn 10% of the inflation reward on this network, I need to stake it. And so everybody's going to stake. And so you're basically growing the money supply by 10%. And the pie has grown from 100 to 110, but it's still the same group of people that are eating the pie, right? So nothing actually really changes. But what I ultimately think is going to happen is that the protocols that have some type of vibrant network fee structure where people are actually paying a transaction fee or are earning transaction fees for participation in this network that are real, right? They're dollars, they're Bitcoin, they're ETH, or they're burn tokens like we have with BNB and some of the other exchange tokens are essentially, almost like, share buybacks. That you can kind of think about almost like a traditional financial asset, right? Like a discounted cash flow. And I think that the incentive alignment that you can do in networks like that actually have a functioning fee market is much more interesting, because now you have validators that might be doing work, right? In Augur, in a prediction market, the validators and Oracle services are going to be the ones adjudicating disputes in the prediction market. In Aragon, the governors of the system are going to be doing, work, valuable work by essentially voting on different proposals, how these different decentralized autonomous organizations should be governed, what the rules, the kind of protocol upgrade should look like. And I think the list goes on from there. But if you don't have some type of bona fide network fee market that materializes, most of these are just going to return to dust. And that's maybe an entirely separate debate, but happy to go elaborate more on that point.
Yeah, and it's a tough balance to make because I think that with the inflation rewards, like I see where you're going, but I think you made the point of like the pie is growing, but it's the same people. But wouldn't the activity on the supply side then drive more demand in some ways? Like if you're able to incentivize people to participate in the network and to earn these rewards, then hopefully that brings life to the project and hence drives demand. Is that the wrong way to think about it?
Um, that works within reason, right? If your inflation is a couple percent per year, and those couple percent are going to developer rewards, or they're basically like fiscal stimulus, I guess, to incentivize people to participate more actively in the network, then I think that's fine. But if you have inflation that looks more like Argentina or Venezuela, you're just issuing more tokens and then distributing them out, and destroying the value of kind of the existing tokens, then it doesn't make a whole heck of a lot of sense. And so I think the jury's still out on what the right split will be. But I am very high conviction that this is not priced in, and you're going to see a pretty clear direct relationship between scarcity on an ongoing basis and where the returns flow.
Interesting. And so in over the email exchange that we were having, you said something about the ethics and of, selling these tokens to retail investors. So do you think projects which have high inflation or these large token treasuries, like they're that do you think it's unethical for them to sell these tokens on retail investors?
I don't think that there's anything wrong or unethical one way or the other, if everybody's kind of consuming the same information and people know what they're actually buying. I think the problem in crypto, and this was the problem for the last couple of years, ever since the ICO boom started, it was just selective disclosures, right? So, I think that in a capitalist system, if someone wants to make a highly speculative bet that some people might say is foolish, they should have every right to do that. But I think the issue comes when the creators of that asset, or the people who are selling it, are being intentionally misleading, or over marketing what they have.
How are they being misleading?
Well, one example could be if you're hiding the pace at which you're selling tokens, right? So if you're promoting the underlying value of some of the tokens on the one hand, and you're touting all of these big partnerships that you have, but the partners aren't actually using the token, right? They're using the technology affiliate, but they're not actually using or holding the token. Or if you're generally just not delivering on certain milestones, and you say you are, there's many ways to fool people into believing that they're buying something that's been fairly communicated, and where the disclosures are pretty obvious. But I think that oftentimes that's just not the case. I won't name names at all because I feel like to the extent that I have already, it's pretty obvious. But really, what I think can be helpful is if the token teams, and in many cases, even if they're not centralized teams, the broader communities have a strategy for aggregating all of the information around the protocol governance, the monetary policies, the key stakeholders, the kind of key milestones, the competitive risks and opportunities, et cetera. If that's all available in one place, then it becomes much easier for any new entrants, not only to have faith that at least this information is being fairly portrayed, but also give them confidence if they wanted to, actively participate in the network or spend any time or resources there, whether it's a direct investment or building on top of the protocol.
Yeah, and this is kind of what you're trying to do at Messari, right? With like trying to kind of aggregate all the information about different projects, their supply, their demand, inflation, etc., so that people have access to this information and they hopefully make better decisions than just buying into the dark.
Yeah, I mean that's exactly right, and it's interesting because we walk this fine line of I think in some cases people think of us as almost like promoting the teams that are on the registry already, or because an asset is kind of listed on Messari or participating in this initiative that they are somehow better than the alternatives that are not. That's not necessarily true. Right? I'm sure that there are going to be many assets and projects that we're working with today that aren't around in a couple of years, right? But that's to be expected in a early stage environment. So it's not so much about the merits of any specific project or whether these are good or bad assets. In fact, we try to stay as far away from possible as in terms of recommending what to buy and what to sell as a company. But the fact remains that you can't even start to have those informed conversations until you have the equivalent of like a very skinny disclosures form, like you would expect from an annual report from a company. And we also have to be very careful about, we don't think that many of these assets are companies, but they're in this kind of gray area where humans have to step up to the plate and maintain these systems, right? Whether it's a fully distributed project or whether it's something that's just starting out, which by definition is going to start centralized. But because these assets exist on a spectrum, thinking about what the common sense, even community disclosures are, community information aggregation policies look like, is probably one of the most challenging things that we as an industry need to get right, and we're just trying to build tools to make it easier.
Awesome, fair enough. So I think what I'm learning from this conversation is basically that like some of the early projects use founder rewards and token treasuries and inflation as a way to incentivize early development of the protocol, but your argument is sometimes it's generating too much supply of days for not enough demand. And so we need to find some in between where the new supply that's being put out into the market is also being kept in check with the demand, making sure there's also demand on the token so that the price doesn't go extremely volatile.
Yeah, that's right, and there are a number of ways to do that, right? One thing that you could do is just lock up tokens in a very long-term escrow. That's what Ripple had done with the lion's share of its XRP, and that's constrained or at least given investors and folks that are looking at that technology and those assets. It's given them confidence that the company is not just going to sell market sell, on Kraken or Binance 60% of the outstanding supply, which is billions of dollars worth of value potentially. So that's certainly one way to do it, but the other is just to start with a more common sense target for what should be the pool that's used to incentivize development versus community efforts versus marketing versus kind of ongoing security of the network. And I'm not sure that anyone's necessarily gotten the mix right because the whole asset class is only 10 years old. But it's one of those things where you can pretty clearly tell when things are not going to work. But it becomes much harder to figure out what's going to be the most sustainable at the end of the day.
Okay, cool. I think that wraps up all the questions that I had. There was one more question that came in that I want to close off it, and he asked, "What about projects with user reward-based token inflation?"
User reward based token inflation. I think that's good, right? And this goes to my point about a fee market emerging. I think that ultimately you can do you can have this inflationary policy where you're rewarding members for certain activity for a certain amount of time, but there needs to be some economic value that's getting captured by that network at some point to fund those rewards. Otherwise, if the value of the network is $1,000 and you're again giving users $50 worth of rewards, but there's no real $50 that's coming in, it's basically just going to depress the price by a commensurate amount so that you kind of you stick it at that $1,000 market cap. And you multiply that by orders of magnitude, and that's what we're obviously dealing with in terms of the stakes for many of these protocols. So I think it's interesting, but a good example would be something like Numerai or Augur, right? So the users that are getting rewarded for their activity are ultimately going to earn fees associated with their actions, right? So if you win a data science competition in Numerai, if you ultimately adjudicate a dispute with a prediction market, right? There's real financial value that's getting tied up and kind of resting on top of these protocols. So if you're able to start generating transaction fees based on the work that the users are doing to make sure that the whole apparatus works, you can ultimately scale that up, and it seems like it's a more self-sustaining method of building these communities.
Fair enough. But what about if, like, the follow-up question was like, is it necessarily bad if these projects have high inflation, if that inflation is, if it's derived from redistributing that value captured back to the users? And I think that comes back to the question of like what you're saying, which is like, if there is value created, this inflation is okay, but you have to be sure that that value is being generated, right?
Yeah, I mean, you'd rather have the price of your existing holdings. You're agnostic whether the price of your existing tokens go up by virtue of getting something like a network dividend, or whether you're just given more of the same tokens. It doesn't really matter unless you're thinking about the denominator there, and what real value is actually getting transacted over the protocols.
Fair enough. Fair enough. I think that is all I had for today. Do you want to close off with a 30-second pitch of how you would summarize your argument for why you believe projects with token treasuries, high rewards, and high inflation will significantly underperform?
Sure. So the 30-second pitch is simple. I don't even know if I need 30 seconds. If you have an asset that is inflating 50% per year, either the population, the demand, or the economic value that's being transacted over that ecosystem needs to grow 50% a year. It's much easier to accrue value, other things equal, if the supply of an asset is fixed or low inflation than if it's growing 50% a year. And you have to always include the dilution assumptions into any investment decision, whether that's a direct investment or an investment of time, energy, or resources to build on top of one of these protocols. So buyer beware if you're getting involved in one of the early stage systems, but that could ultimately pay off. It's just a matter of what your risk appetite is and whether you think that we're going to see another 2017 like bubble for some of these tokens.
Awesome. Thanks, Ryan. Really exciting conversation. I got a lot to take away from here. So thanks for joining us.
Thanks, Preeti.
Awesome.